Good morning, everyone. I think I can see Sandeep has also joined in. I hope I'm audible to everybody. Hi Manish. Hi Sandeep. Hi Gourav.
Hi, everyone.
To the panel, and thank you so much for joining us. I think you have.
Hi Manish. Hi Gourav.
Hi Sandeep. Hi Manish.
Sorry, there seemed to be some trouble in the beginning in folks joining in, some technical issue. But I think we are almost on time, just 3 minutes delayed. So I think we can get started now. We have attendees who are joining in as well. A warm welcome to everybody. I think the folks who have joined in, the folks who are in the panel, for everybody, the digital lending guidelines are on the top of everybody's mind. So we decided to have a discussion here with some esteemed panel members who have the experience and who have basically worked through what is required to adhere to the guidelines and yet ensure business continuity and scale for NBFCs as well as fintech partners. We have today with us 3 esteemed panel members. We have Gourav Dokania, who's the CFO and head of legal for Uni. We have Manish Motwani, who heads partnerships for digital lending at Piramal Capital. And then we also have Sandeep Singh, who's the head EMI solutions for digital and retail lending at Aditya Birla. I am the director of new initiatives at Cashfree Payments, and we have had the good fortune of working, with these folks and also with many of you who are attending here today to help you and support you in enabling adherence to the digital lending guidelines and also to help you scale. So the idea of this discussion, of course, is for us to understand from the panel members on how they have gone about in the last 2.5 months since the DLG launch, how they've gone about ensuring adherence while also making sure business continuity happens. I would also request attendees, I can see that attendees are joining in quite rapidly. We would want to keep this interactive as well. So please, post in your questions. The plan is to take the questions as we go instead of waiting till the end, so that we can have as many of your questions answered as possible while we continue having the discussion. So I'll get started then, Manish, Sandeep and Gourav. So the first question is actually for all 3 of you to get your views, basically. So what has been the key focus areas for you to ensure adherence to the guidelines while ensuring business continuity? I would like to start, Manish, with you. From a Piramal point of view, if you could help us understand what has been on the top of your mind ever since the DLG has come in terms of ensuring adherence and business continuity.
Right. So when the DLG came in, right? So there was already a precursor to DLG that had come in to give us a flavor of what RBI really wants. But in the DLG, they clearly articulated the very specific 3 areas for them that they're looking in. Top of that is customer clarity in terms of disclosures and data storage. So even if you look at the number of items within the DLG, they're more focused on customer grievance related and disclosures related than other regulatory things, right? So for us also, we take cognizance of that. For us, what we've really tried to focus on building, and this was always been in our stack since we've done partnerships, is to ensure that whatever is being communicated to the customer, both in terms of letters, documents, or what they see on the app, is pretty clear. So there were certain changes because the formats were specified by RBI now in terms of KFS, GRO details, etc. So that was our number 1 priority, also to ensure that whatever we are doing in terms of product constructs, also they're simpler for the customer to understand in terms of fees, charges, etc. Right, and all the details of who is the LSP, whose responsibility is to collect, what is the role of an LSP here, who's actually underwriting, who's actually giving the loan, because they should know who's actually the lender, right? All of these should be made very clear. So that was top of the mind for us also. What RBI also made pretty clear in this guideline was that the lender, who is the regulated entity here, has to ensure this compliance, and also in terms of the controls of the entire product, be it the repayment or the disbursements, right? The idea is for RBI to be able to monitor where the fund is coming from and going to, right? So that's why it has to be directly between the lender and the customer or the end beneficiary without pooling of accounts, which we were already pretty sure of that this is happening. But with the guidelines, it became more clearer, and everyone is on the same page, whether the LSPs or us. It makes better for us to sail through and implement these once the guidelines are there, instead of when the guidelines are not there, right? So these are things we are focusing on. Over to you, Gourav, Sandeep, you guys also, if you want to add up.
Hey, sure. Thanks, Manish. So I think much like what Manish mentioned, I think RBI gave a precursor and it's been in works for over the last 1.5 odd years. Fortunately, we were also part of the committee where during our last year's annual inspection that RBI did, there was a lot of understanding of how these business models are being worked upon, and it's over the last 2-3 years the way these business models have rapidly scaled thanks to the ecosystem partners and NBFCs and few banks coming into the play. So we knew what was coming across, and I think to the larger context, it puts customer in the center of everything, right? Whether it's a fair practice code, whether customers' understanding of how he's being given loan to under what pretext. So the RBI just decodes it, and I think having some Bible to follow is much better than each individual making their own interpretations and running the business models. So I think overall the net outcome, it suits well. It would have caused disruptions of 10-15 days here and there, but I think overall it's much more aligned. The LSPs, the TSPs, your DLAs, the NBFCs and regulated arms, everybody knows what needs to be done now. So from a changes perspective, of course, one clear guideline on the fund flows and not doing through pooling accounts is also from an understanding that customer really knows how the fund is flowing. There's no undue advantage of these funds being taken by the industry. We being in the upper layer of the NBFCs anyways, we were being abiding by all these through rules and laws, which meant we doing the underwriting, thorough underwriting of the customer, we making those eligibility of the customers. So it was pretty easy on that direction. Certain aspects on format, certain aspects on KFS, certain aspects on cooling off periods, fund flow management. I think these are works in progress. I think all of us, and I say on behalf of all here, 2-3 months down the line, this will become business as usual for the industry and everybody would know. So it appeals well, it augurs well for the industry to grow further as it takes a new growth into the next sphere.
Yeah, thanks Sandeep, thanks Manish. If I would say that both Manish and Sandeep have encapsulated the thoughts really well. What was on top of my mind or our mind as a fintech which was partnering with multiple NBFCs. So I think like Sandeep said, the customer is in the center of all this, because there was a lot of malpractices, which I would say that where mis-selling was happening, the customer didn't know, right? And what I would say is the DLG is a welcome change of sorts, because it actually allows for the orderly growth of fintech in consonance with the REs, right? The relationship of the fintech and the REs becomes slightly more clearer in terms of what does the RBI think of the fintechs, what does the RBI think of the role of fintechs, DLAs and the LSPs. I think that was something, while there were precursors, that was something which was widely debated over the last 1.5 years. In fact, when the digital lending guidelines came in, there was a debate around who do these guidelines apply to? What is the definition of digital lending, right? I mean, remote and automated and largely, quote unquote, largely digital. So are there REs which will escape out of this route? I mean, there were these kind of discussions as well. But to come to the point on terms of what is on top of our mind as far as the DLG is concerned, I think fund flows. I think predominantly a lot of fintechs were operating using pass-through, pooling accounts. So that has been modified, and I think it's a work in progress, as rightly put by Sandeep. It's a one-time pain, and I would say that the compliance requirements of the digital lending guidelines separates out the serious fintechs from the fly by night ones. So it is definitely a welcome change in my mind. People who are serious about this would definitely embrace this, and there's no other way. Things like key fact statement, what does the customer get to know, and knowing it upfront instead of signing up and then knowing that all of these terms and conditions apply to the customer, right? Data privacy, data consent, purpose driven need based consent should be given to the LSP and the DLA, right? I mean, no access for media files, contacts, all of that, right? Which was predominantly been taken by a lot of apps which were masquerading as lenders, but they had a lot of other motives, right? So so all of this has actually put in shape, at least put a structure, I would say, to the growth of digital lending in India. And I think RBI, just to congratulate, the RBI has actually been a very responsible regulator. If you look across the globe, and it has been always watchful. So I think it is an overall positive. It will be a business as usual in 2-3 months time, and yeah, I mean, there will always be some pockets of non-clarity which will be there, some ambiguity which will be there, which will be clarified, and maybe there will be an industry opinion which will come out on various small topics which still remain, right? So that's my view, Aditi.
Thank you. That's great to hear from all three of you. In fact, I think the bottom line here is that this is for the good. This is going to actually help both the fintech world and the NBFC world grow hand in hand, and it actually helps weed out the long-term players who are in it for the long game versus the ones who are trying to work things around. Maybe even in a non-compliant. So it's great to hear that the industry's feedback is very, very positive on the new digital lending guidelines. I also want to mention here, while we go into the next question, I can see a few hands raised here. For whoever has questions, you can there's a Q&A section here. You can just put in your question there, and we will definitely take it up during the conversation itself. And if we are unable to do that because of time, we will reach out to the panel members and get responses from them and get back to you for sure. So meanwhile, I think one of the things we talked about is the fund flow, which Gourav mentioned, which is critical, right? Both from a disbursement and a repayment standpoint. So Sandeep, just a question to you. I think that's one of the things that the ABFL team is working on right now to ensure that the fund flow can happen as per the guidelines, while also ensuring that flexibility and the business models of fintechs can be accommodated. So just wanted to understand from you how you are going about it from an operational, compliance and business standpoint.
Yeah. Thanks, Aditi. I think one of the clear directions laid out by the regulator is that the fund flow remains between the RE and the end customer in place, right? And this had few changes from the way model was working earlier. In a typical personal loans where the money needs to flow to customer's account, anyways, this was not much of a problem earlier as well. The money was always going to that, and the regulations, if you would have, if we look at that on a end where the end use is directly to the customer's account, I think that's where largely the regulations were tackling into or targeting, that the money need necessary flow in there. I think we were always working on that model. In a typical term loan environment, the money would always go to the customer to remove any ambiguity of being transferred through a pooled account or so on. However, for us, we also do a lot of end use based loans where the money needs to go to end beneficiary, which finally came in the second part of the circular that the regulator came up with. In that, the way we see it, yes, it is possible. The way we want to do it, of course, the fintechs and our partners also places a request, because there is a lot of flexibility required from a merchant's end, where the end use is a merchant, and they would want and the genuine use case the merchant wants not to receive 1,000 loans or 1,000 UTRs in a day, and would really want to have a single payment coming through doing a debit and a credit. And therefore that's where I think, Aditi, we started talking as well, right, on the solutions, multiple solutions that we are approaching. One is upgrading our own tech stack, where we can do this directly with the end merchant, where the relationship is with the end merchant, the sourcing of business is happening through there. In certain cases, our end merchant is little far away from the regulated entity like us, and are in much more closer touch of the ecosystem partner who is actually getting that customer on board. And therefore, I think the solutions like few that, Aditi, you guys have worked on, come along in the last couple of months, has played an important role of managing and building that flexibility in that. One of our pain points that you as a technology service provider helps us is that we need not put our recons and operations team in place to do this end-to-end management, while you work on our fundamental account, but the direction through our LMS, through our technology, reaches from where this fund flow needs to be there. And you act as a technology provider, gives us ample comfort on the recons, give that ample comfort to our fintech to manage this solution. I think the time is of essence when these solution comes in, right? With the regulatory timeline of 2-3 months of implementation. That's where we wanted some extra help and support from outside who can help build this stack for us. Fortunately, we are in that stage where we are building this stack, which will be able to expose it to our ecosystem partners. They will be able to see how the fund flow is happening, at least at a read value of understanding. When they are talking to their own merchants, in the end, they can pull out those reports, send it to those merchants of how the UTRs and everything is happening. I think it's again, like I said, it's a welcome move. Clearly defines the position of what the regulated entity is supposed to do. Clearly defines your solution as a position as a technology provider who works on our accounts to manage these fund flow for us. And that's the way we see how industry also adopting in that. But on a end term personal loans where the end use is specific to customer's account, where there's no third party involved, my fundamental belief is we should directly disburse it into the into the end customer account, and we should not have any use case of any other solution in place. So that's the way I see it, Aditi.
Sure, absolutely, Sandeep. So again, I think the point here is, adopting solutions where compliance is in place in terms of, and the reason, of course, the rationale behind, the RBI asking for, lender to borrower is to also have a clear trail of money and avoid any confusions even for the borrower, right? So it is in the interest of, protecting the customer, but also in the process helps the REs and the fintechs also, keep their books in order in that manner. So great to,
as long as we are able to clearly define the rules and responsibilities of what RE is supposed to do, what you guys as a technology service provider is supposed to do, what my LSP is supposed to do, I think then everything becomes very kosher. It's as black and white. I don't think there's any ambiguity as far as what regulator has defined on this section. So I don't see much of a challenge as long as you just adopt what needs to be done. It's good to go.
If I may add, it puts the RE into the driver's seat as well, because what was evolving in the last couple of years or maybe more than that is the practices where there were pass-through accounts, the REs might not have had the exact amount of control, right? So by placing the responsibility on the REs to not allow pass-through accounts in between, it definitely puts the RE in the driver's seat. It also, once it has put the RE in the driver's seat, is also, like was mentioned earlier, that the responsibility is also of the RE in a lot of ways to ensure that all sorts of compliances are being maintained in the whole digital lending process, be it data, be it the explicit consent of the customer. there are various aspects where you put the customer in the center so that there is no confusion and there is enough control with the RE and in a way with the RBI that who gets the money, how he or she is getting the money, right? There were only two exceptions to my mind, which was carved out, which was one around co-lending, and the other one was on specific end use, which probably a lot of people have interpreted it as the BNPL, the carve out for the BNPL lending, right? Apart from that, there's hardly any carve out which has been made for any sort of transfers for whatever use case. And I think all business models will have to evolve around it because the end customer should not be confused in who's lending.
Understood. Absolutely. I can also see a bunch of questions have come in. So maybe we can start taking a few questions as well because I think the audience is also trying to get clarifications around some of the things. There is one question from Nagaratnam on when is the next clarification on FLDG expected and what will be the expected clarification. Of course, this is just I'm guessing at this point an opinion that is being asked for because until we get any further clarification, we do not know what a clarification could be. But I'll actually ask this question to Gourav from a legal standpoint. I'm sure that you guys are evaluating what this could mean, right? So just get your opinion, your view on that.
Yeah, I think RBI. I wish I was RBI when I could actually mention when it is coming out. I think nobody knows when the RBI is coming out with this, but RBI definitely laid out a few things. Like it definitely mentioned that synthetic securitization is not allowed. So FLDG in that sense between a RE and a non-RE has to go away. There is no question about it. The models will need to evolve is all I can say, right? I mean, the industry is evolving. And the FLDG, like the RE definitely needs to factor in the risk and only then enter into the arrangement with a fintech in terms of what kind of customers they are sourcing. So it kind of boils down to the RE taking the responsibility of the credit losses, figuring out whether the kind of lending which is happening is something that it would want to get into on its own, right? So which is very different from say what happened elsewhere in the world, right? Where people, where fintechs were funding the losses and customers of various qualities were various risk profiles were getting credit, right? So I think in summary, I would say that timelines is something that which only RBI can mention, but for us there is enough clarity that there is going to be no FLDG, and the models will need to evolve. The kind of risk segment, the kind of risk which an RE will need to take will also need to be evaluated individually by the RE and the LSP or the DLA.
Yeah. Just adding on to it, see, REs are supposed to underwrite risk, and therefore by that sheer sense, FLDG becomes an oxymoronic statement, right? And I think there is ample clarity. I don't expect any guidelines further coming on FLDG. It's very clear. If you are doing with a non-RE with a fintech partner, you treat him like a fintech partner as a sourcing acquisition channel. That's the end of it.
Yep.
Like you run your own physical personal loans, business loans like DSAs, it's similar. Fintech adds a lot of value in doing sourcing customers, maintaining customer journeys, helping underwriters at RE's end to underwrite better. But you can't run away with not underwriting. Let's put it this way.
Valid point, I think, and also provides a lot of clarification around FLDG, which by itself was shrouded by some amount of doubt for a while now, right? So great to hear both the fintech and the RE's point of view on that. We'll take one more question from the attendees. So this is actually about co-lending. So the question here is that is this the DLG, is this a direction towards moving towards a co-lending model and moving away from a BC model? So I know that Piramal also does co-lending with some other partners. Manish wanted to get your view. I mean,
Sure.
my personal opinion is that it's not an either or; it will continue in both ways. But from an RE perspective, from an NBFC that is doing both co-lending and working with the LSP BC model as well, right? So, wanted to get your view on that.
Yeah. Sure. So that's exactly what RBI is trying to say, right? RBI is saying the regulated entities are in the business of taking risks and should continue to take risks. If you are a fintech, purely a fintech, non-regulated entity, do not enter into a risk-sharing models. Help the RE underwrite better with your experiences, data, etc. But do not enter into risk, because RBI is not able to visualize where the risk is sitting, right? So you can continue in a BC model. If you are an RE with well-capitalized balance sheet and are desirous of taking risk, you can take a co-lending approach, where by design, because you put money on the balance sheet, you're obviously taking some portion of the risk, right? That helps you create better outcomes, because you're an RE and want to take risk, and hence also upside to reward. That helps you to. So both models exist. Depending upon what kind of business you want to be in, what kind of entity you are, you can choose either a BC model where you're just sourcing for the partner, or you can be a co-lending model. And we are also doing both kind of partnerships with everyone.
Got it. Makes sense. I think one more question. This is more of a clarification question, I think, and I request Sandeep to answer this. Is from the audience is, the guidelines, are these applicable only to purely digital lending entities, or if an entity has both digital presence, so provide loans through DLA directly, and as well as have physical presence through branches, will these guidelines be applicable for those entities? If so, in what shape or form? Is it basically, the two entities will be considered as different, or will this apply for both the entities? How is, for Aditya Birla, how does this pan out basically?
So at ABFL Aditya Birla, we run both the models, right? We do have our retail lending business, which is a brick and mortar business, where of course the flow of application is all through digital channels, but eventually the underwriting, or there is a physical touch involved, right? DLAs is in simpler terms is like a website extended arm of acquisition of channel, where you are underwriting the customer digitally. And I think the intent of the regulator was on this direction, where the physical touch or touch and feel with the customer is little bit missing by the regulator, which is primarily has been digital lending as a channel that has cropped up over the last 2-3 years. So it's not black and white from that perspective. It's more to do with the intent. Where in our physical line of business, where we source either directly, our sales manager sources the customer directly, or through DSAs, there is ample touch points that the customer is aware about of whom he's taking loan, and there is ample touch points from an underwriting point of view that the regulator RE is touching base on customer on whether he is eligible or not. So if we understand the underlying intent of the regulation, then it becomes clear of where to adopt this and where not to adopt this, right? There is enough and more clarity when we do loan agreements in a typical personal loan sourced out of a city, from a DSA or from otherwise, right? There is enough and more clarity there. I think that's the way to look and define. It's pretty clear. Both models runs extremely well for us, and will continue to do that. I hope that helps answer.
Thanks, Sandeep. That's very, very helpful. If there is any follow-up question, do post in on the Q&A. There's one more question regarding, the calculation of APR and, having the KFS in place, right? And I request Gourav to answer this question. So the question is that there is a requirement of effective APR to be mentioned in the KFS. So in case where there is subvention received by the lender, would that be part of the APR calculation? That's the question. And if yes, then there is ambiguity being when subvention is not paid by the customer, then why should it be part of the APR? So a slightly technical question, but I think Gourav will request if you have an understanding there from the LSP perspective, or maybe one of the REs can also help answer that question.
Yeah, sure. Thank you, Aditi. I think I'll just give you my personal view on this, because the APR as a metric is still evolving. We must accept the fact that the digital lending guidelines have just come in. But there has been some background to say subvention as a model, right? If you go back in the day, maybe 5, 6, 7 years back, when Bajaj was doing subvention, right? They pioneered the subvention model in India, and everything was being sold as a zero interest, zero EMI, zero interest EMI kind of a model. So RBI had come down very strictly in terms of saying that you have to make a disclosure in your um, in your loan statement, that what is the effective interest rate of the loan, right? So it was being called effective interest rate earlier. The subvention was supposed to be mentioned back then, and my understanding says that by whatever way the RE is going to make money out of the loan, it kind of blends into the effective APR of the customer, right? The customer may or may not be paying it. So the whole so that's my understanding of the matter.
Understood. Any views from Sandeep and Manish on this?
I think Gourav has clearly articulated this. That's how RBI wants it to be. While you would know as a customer that is zero cost EMI, but you should know how this being funded by your OEM or the merchant, right? So that's pretty clear how Gourav has put it.
Great. Thanks, Manish. I think coming back to we discussed about the disbursement side of the money flow. Manish, a question for you on the repayment side. Of course, again, there were innovative ways in which repayment partnerships were happening with fintechs, and LSP partners. So with the new digital lending guidelines, again, do you see any critical changes happening there? If so, what are those, right, versus what was happening in terms of repayment methods for lending?
Right. So if you go back to RBI's intent, the intent is clear that the relationship has to be between an RE and a borrower. So both sides of money flow, whether repayment or the disbursement, has to be direct. Now in the repayment, again, while most of the fintechs were sort of taking the repayment from the customer and giving it back to the RE, there was some bit of pooling happening. The primary reason for this was mostly to control the information flow from a recon perspective, so that fintech also knows that the customer is paid, because fintech has to do some level of servicing or collection, right? Most of the fintechs did not have any ill intention of it, but as Gourav said, there were a lot of fly-by-night fintechs who were taking undue advantage of this this relaxation, where the pooling of funds was happening. Maybe funds are getting mixed, one customer's funds with another, and hence some outcomes which RBI did not want it to, right? So what RBI did to ensure that is that they said, okay, look, the fund has to flow directly into the RE's account, where RBI can also tomorrow, if required, to audit and has a visibility of that actually the customer is paying, the same customer's repayment is applied. It makes more clear now, and with the technology available, that even if the fund is flowing directly to the RE, I can in real time inform my fintech that, hey, look, this customer's fund has come, so that they are updated, right? Plus the fact that RBI has now also regulated some of the PAPGs like yourself, the likes of entities like Cashfree, etc., are helping us build that stack where this information can flow in real time between an RE and a fintech lender, so that it solves for the pain point of the fintech that they need a visibility, while the fund flow can be direct to the lender. And we are also solving in that way that most of the mandates now with our partners, unless we are in co-lending, have to be in our name. The fund has to come to us via some of the TSPs like you, who are powering these solutions, and the information can directly real-time flow to the fintechs.
Understood. Thanks a lot, Manish. I think that also helps a lot of NBFCs and fintechs where the repayment itself, was a cause of concern. So this is super helpful. We are getting a bunch of questions with respect to BNPL as a model. So wanted to request Sandeep, if you'd like to take this question. I think I'm trying to club a couple of questions here, but the bottom line question here is, how does BNPL work with respect to the new digital lending guidelines. Wherein the money is actually going not from lender to borrower but to a merchant. Is this, if it's an exception, how, what is allowed, what is not allowed? Just an overview of how BNPL would work in the new DLG.
Yeah. So I don't think so. Regulator till now has put up any specific guidelines on BNPL, and therefore the way we interpret at Aditya Birla is that they needs to follow in the similar guidelines what has been laid out on the fund flow management, where the end use becomes eventually to a merchant, online merchant or offline merchant, and therefore what I spoke earlier. In the end, it's RE's responsibility, and my colleagues Manish and Gourav also mentioned in there earlier. It is RE's responsibility when it comes to fund flows, right? As long as they do it directly or through some solutions, technology solutions such as Aditi yours. I think BNPL also comes into that direction. Yes, it becomes little painful from a recon from other side, but that's how the technology has to evolve. I don't think so. That's my personal opinion, though, that there will be any fresh guidelines with respect to BNPL that will come in, that things will continue the way it was continuing earlier. So at our level, we are considering whatever the guidelines that are laid out are applicable for the BNPL business. Instead of a 3-month loan or a 6-month loan, BNPL is just a 30-day loan. The velocity increases, the rest all remains the same, right? That's the way to look at it.
Right, absolutely. I think there was a question around consumer loans also, where the disbursement is done to end-use merchant, which will fall in a similar category from a regulatory standpoint, basically. Right, great. There is one question also about trade-related lendings, and I'll actually request maybe Gourav as somebody representing a fintech, because the question here is, will fintechs be permitted to function as a sourcing partner for primary lenders like banks in this respect, or will they be permitted to become a lender themselves according to the DLG?
I think Aditi, the answer is straightforward here. Fintechs are not an RE. They are not allowed to be a lender. Number one. I think fintechs are welcome to be a sourcing partner, a technology partner, enablers, in all sorts of. If you go through the digital lending guidelines, in fact, RBI has actually clearly defined the role of an LSP, and it is pretty wide, right? I mean, you want to take the help of a fintech, go ahead, take it, but the driver's seat still remains of the bank or the NBFC, right? I think. I'm actually not, maybe I'm not understanding the question, because for me the answer is very straight out there, that the fintech is not a lender.
Yeah, I think if I am just trying to interpret the question, my understanding is that there are certain kind of lendings where the entity is not an NBFC, but they're giving trade finance, let's say trade finance and trade lending kind of use cases. So, how would that fall in the purview of DLG? Probably that's the question, if I'm understanding it correctly. Whoever asked the question, clarify if we haven't understood it correctly.
I think beyond the DLG as well, the NBFC guidelines actually make it very clear in terms of, even the RBI guidelines make it clear that, say, there are models like invoice financing. There are models where one merchant is giving credit to the other, right? So, if that is the question, I think you go back to the previous guidelines and just refer. See, the digital lending guidelines is a layer on top of everything else which already remain. It's not changing the way lending is happening, right? It's just bringing more disclosure. I think Manish put it very rightly. Disclosure is at the heart of this whole guideline. Disclosure, clarity, transparency, right? What was missing in digital is what was happening in the physical world, right? When a customer goes to a Chroma show and he sees an ABFL outlet, he knows that it is ABFL for sure, right? He knows that he's going to get a loan, and he knows that he is going to get it on what terms. He has a person who he can reach out to. All of it was, not being followed, I would say. If I would say that not everybody was following it in the digital lending ecosystem. So, the answer would remain that the digital lending guidelines is a additional way of looking at things. I would say that even the traditional lenders have now got a framework in terms of what the customer needs to know and what the customer was not being disclosed earlier. Because sooner or later, the RBI is probably going to hold them to at least the large lenders to the same benchmark in terms of their processes and the practices. Because ultimately, there were a lot of customer complaints around digital lending specifically, which is why all of this is happening. Yeah, but long story short, this is going to digital lending doesn't change what was already allowed.
Understood. Makes sense. Since we only have a couple more minutes left, I think we do have a few more questions, but we'll try to take some of them offline. But one, question for all three of you, which should be helpful for the attendees, is from your own learning in the process of adhering to the guidelines, what is your advice and recommendation for REs as well as fintechs? Of course, one is making sure the adherence happens on time, but the other is also continued adherence, right? So just wanted to get each of your advice and recommendation for the audience here. Sandeep, maybe starting with you.
Yeah, I think to put it in a nutshell, it's a hard work both at fintechs and REs end, and there are no shortcuts of scaling business either ways at either ends, and therefore I think being on the right side of the line in law is extremely important for us and our partners in this journey for a continued scale up. That's one. I think from an RE, from our perspective, investing in technology stack, having that agility to undertake these changes either by regulator or the changes that innovation that continues to happen at fintech is of prime focus. So I'm saying there's no shortcut to this. We have to do it. Partners have to do it for a continuity of the business and scale up.
Thanks so much, Sandeep. Manish, wanted to get your view as well, your recommendation and advice for REs and also fintechs, of course.
Of course. So, the RBI is very clear in this regard. They do encourage innovation, which the fintechs have brought in, and they time and again recognize that they themselves have set up fintech units now separately. So they really mean for fintechs to be in business. What they really want is keeping the customer transparency and disclosure and customer protection at the center of it. While a lot of fintechs were innovating, somewhere that spirit was getting lost by not so serious fintechs. Hence the guidelines. So as long as fintechs are serious about this business and keep the customer transparency protection at the heart of it by way of disclosures and by way of data protection, data privacy, I think all that is fine. Coming to the other aspect of it, which is on the risk taking, again, RBI has been very clear. It's the REs who are in the business of taking risk. Let that sit on RE's balance sheet while you continue to help REs innovate on the product. And I think today the technology has evolved to a level where if you're creating a serious business of lending, you can have a very tight integration with the REs and get all data, recons, etc. done. So by way of guidelines, what RBI has really done is made it clear that only a serious fintech who wants to really create a good digital business out of it remains in business, while the not so serious ones may over a period of time go away.
Thanks a lot, Manish. That's pertinent, definitely. And Gourav, your point of view, as a serious fintech in the business, how do you see this, and what is your recommendation for other fintechs who are looking at lending partnerships as one way of building?
I think the framework which we follow here at Uni is don't move from one gray area to another gray area in a bid to outsmart RBI. That's advice number one. Because that's actually taking a very, very short term. It may be okay, I would say, where you are taking the harder path and it is taking some time, right? Maybe you'll have to take a hit in the short term for it, right? But that doesn't mean that you have to move from one gray area to another, right? I mean, looking for the most compliant solutions and where you fall in the compliance matrix when the day of reckoning comes with RBI, that is very, very important, right? I mean, I would assume that the serious fintechs would also want to become an RE someday, right? I mean, that's the logical step forward for a fintech is, right, a serious one. So I think that's the point number one, and I work very, very closely with the REs to ensure that there is enough comfort around the LSP's practices, right? Be it collection practices, which has been a cause of a lot of suicides. All of that things are happening. So recently, I mean, it's not fintech, but recently there was a very public thing around some large NBFC where a collection agent was directly responsible for the death of a borrower, right? So that, I mean, the comfort around the practices of the LSP is very, very important, and the LSPs work very closely to ensure that the REs get are comfortable saying that we have. So I think these are the two things. Beyond that, I mean, the whole space is evolving, and we will continue to innovate around better products, more seamless experience for the customer. Obviously, work with guys like Cashfree to bring out very seamless experience.
Great, thank you. Thanks for that opinion, Gourav. I'm sure that a lot of fintechs would really benefit from that point of view, and also that of not trying to take go from one gray area to another, but to actually build long term. In fact, I think what I take away from one key thing I take away from this discussion is that, of course, first of all, DLG is keeping the consumer in the center, right? Consumer. Protecting the interests of the consumer, but it also ensures better and stronger relationships between REs and fintechs, defining accountability, defining roles clearly, and it's also meant to ensure that the serious players who are looking at the long-term game, they are in on it, and they are the ones who will build this out, keeping compliance in mind, but also building for scale. So that's super helpful. I know that there were a few questions we weren't able to take up because we've run out of time. But we'll try to get those answered offline, definitely. And also reach out to us if you have any other questions. Reach out to us, and we will try to get those answered from our panel members. Thank you so much. Thanks all of you for joining this, and for the very, very informative session. I hope the attendees were able to take away clarifications and insights from this session. And thank you everybody for actively joining and giving your questions in as well. Super interactive session. Was really enjoyable for me also to moderate. Thank you very much. Thanks everybody, and have a great day.